You've likely come across some content in the last few weeks citing China's entire economy, how it's poised to collapse in the next 30 days, and why their financial meltdown is escalating out of control. We also had a video a few weeks ago that covered several of those points and documented how severely their markets were impacted. But in a desperate effort to stay afloat for a little longer, China has done the inconceivable by lowering interest rates and injecting even more money into the economy. They are not only experiencing one of the most damaging housing bubbles in history, but their economic slump is already affecting the rest of the world. And there are some serious consequences for all of us that you should be aware of, because it's not a matter of if it will happen, but rather when. And that is an issue that needs to be addressed. Until recently, China was on an unstoppable collision course with anyone or anything that stood in its way. This is because China has been at the front line of production, global investment, and accelerated productivity for the last 30 years, all because of a 1979 exchange that granted China diplomatic relationships with the United States and, by extension, the rest of the world. China and the global economy suddenly shared a common goal. Money poured in as soon as that door was opened. Countries from all over the world decided to invest in Chinese facilities, taking advantage of low-cost labor and bringing much-needed funding to previously closed-off areas. Even though this reduced the cost of almost every item we use on a daily basis, the benefits to China were enormous. With increased trade and global investment, 400 million people were moved out of poverty. Furthermore, their economy is now 11 times larger than it was in 2001, and they have been dubbed the world's economic miracle for growing at a faster rate than any other nation. However, not everything was as it appeared on the surface, because as China grew, it became more powerful in comparison to every other nation. The more leverage clout they had to maintain firm control over their businesses, the more regulation they could impose as they saw fit, and the more difficult it was for them to form alliances with. Members of the World Trade Organization have accused China of offering illegal state subsidies to businesses that export their products, discriminating against companies that do not buy from Chinese manufacturers, and dictating supply chains by taxing raw materials. Worse, it's been reported they've been depreciating their own currency by up to 40% as an incentive for other countries to be able to buy their own goods with a price reduction, leading to unsustainable growth in the economy that was set to crumble in a year. Nothing better describes the current condition of China's economy than the saying, "The higher you climb, the harder you fall," because of how it is rapidly becoming a victim of its own success, with a massive impact that is beginning to be felt throughout the whole world. First, consider the consequences of a zero-COVID policy. This literally means that there is no tolerance for the spread of COVID, to the point where China will impose strict lockdowns, maintain tight restrictions, and do everything in their power to keep the population from being infected. However, it has already begun to take its toll. China's stock market has had its worst quarter in years. Their economy has begun to deteriorate as global recession concerns grow. Supply chains have been severely impacted by a delivery backlog, and growth is not expected to be happening. Not to mention that these policies are so harsh that all citizens are required to use a health code app that determines who and where they can move around the capital. If your health code turns red, you are sent to isolation, along with anyone you have come into contact with, who may also be considered high risk. These consequences have made their daily lives difficult. Second, their real estate market. Nothing saw an increase as massive as the housing market, or price increases rose by nearly 700% from 2001 to 2017 as China's economy expanded rapidly. In fact, the Chinese government understood that this was becoming a significant issue, so they imposed restrictions on who could obtain a loan. But at that point, it was a trivial effort. Large developers have already taken advantage of all of the real estate excitement by selling unfinished units with the expectation that they would be worth much more by the time they were finished. Citizens purchased completely empty cities as a means of storing wealth. And because of the high demand, there was little monitoring to make sure that all of these properties were being built now in a constantly rising market. This would not have been an immediate problem because developers could always raise additional funds by selling more pre-built units. However, with sales collapsing in their worst real estate slump on record, those previous projects are now being abandoned, leaving consumers to fend for themselves and pushing them to make payments on a property that isn't even being built yet. Finally, the debt crisis is the third and final nail in the coffin. According to the Wall Street Journal, China's debt increased by 20% per year from 2014 to 2018. Housing prices are nearly twice what they were before the 2008 financial crisis, and China continues to ease lending requirements to ensure that growth continues and is maintained at all costs, even if it means harming the global economy. But in terms of what we're dealing with right now and how it could lead to another ticking time bomb, here's what's going on. China did the unimaginable in response to their economy's slowing growth, a declining real estate market, and falling demand by reducing interest rates to help encourage more growth while simultaneously pumping $60 billion into the banking system to reward lending. They reassured everyone, however, that the government will not implement huge initiatives or flood the financial system with new money, but will instead aim for reasonable costs and fairly decent economic performance. Despite that, this does not square with the fact that growth projections have been revised downward, and the zero-COVID policy has taken precedence, leaving China with an economic system that now has far more room to fall. Their president, who is expected to secure a third term, recently stated that he would rather temporarily affect a little economic growth than risk endangering people's lives, safety, and physical health, particularly the elderly and children. Others are concerned that this is simply a patsy for the far deeper issues of economic insecurity, namely the fear of spending any money. Any developing economy wants their people to feel secure enough about their finances, to purchase more items, spend even more money, take out loans against their assets, and be able to invest in expanding infrastructure. However, with China's economic outlook deteriorating, more and more people are hesitating, leading to a self-fulfilling promise that prices are dropping because consumers are not spending enough money. And because consumers are not spending enough money, prices are falling, and the vicious cycle continues. It's also worth noting that Beijing's crackdown on real estate developers' dependence on debt has an impact on households' perceptions of wealth, given that the majority is invested in real estate. This is particularly true considering that 96% of the Chinese population is exposed to a property market that has gone down for 11 months in a row. As a result, retail sales in April fell 11% year on year. In an attempt to stimulate spending and then the economy, the Chinese government issued what are known as consumption vouchers. These are government-issued coupons that provide discounts for shopping at various businesses. The goal is to encourage people to spend more money by providing an incentive to do so. It may look like it's working in the sense that it makes the numbers appear better than they actually are. Supporters say that these consumption vouchers increased spending by 3 to 10 times their face value. Others argue that it only benefits those with extra money to spend without tackling the root cause of the problem, and that China's economy is quickly declining. In a normal market, such a money injection and rate cut into the economy would be interpreted as an optimistic signal for almost anything. However, in this case, it is viewed as a negative sign and a failed attempt to keep the economy going for a little longer. According to Goldman Sachs, mortgage sanctions have made people much more hesitant to buy a home, resulting in 28.8 fewer sales, which demonstrates a loss of trust in the housing market, which also reflects a loss of confidence in the entire economy. And this is something that can't be solved by lowering interest rates. Furthermore, oil prices have begun to fall, with the assumption that China's economy has officially begun to decline. After all, China consumes 15% of the world's oil and imports the most crude oil of any country. When they slow down, the rest of the world may follow. What does this mean for all of you who are watching, and how might it affect all of us in the United States? Aside from lower oil demand, which results in lower gas prices, there are a few main points to keep an eye on. The first is the blacklisting of Chinese stocks from the New York Stock Exchange. The 5 state-owned companies were recently blacklisted from the U.S. Stock Exchange, citing a high administrative cost and expense as the reason for their decision. However, the timing is just a few months after the SEC flagged these companies for failing to meet U.S. auditing standards. This raises the possibility that more businesses will follow, because if a company is going to be publicly traded in the United States, it must follow strict disclosure requirements. This also involves a fully verified third-party audit to be conducted on a regular basis to ensure transparency and accuracy. This avoids disasters like Luckin Coffee, which was accused of misrepresenting financials, raising funds in the United States, and then collapsing when those numbers proved unworkable. And as of now, 261 Chinese stocks could be delisted if they refuse to comply, which is a reality that we should be ready for. After all, China has stated that it is reluctant to allow foreign regulators to investigate local accounting firms due to concerns about national security. And with the clock ticking, China must either cooperate or risk having over $1 trillion blacklisted from our US-based markets. Second, be aware that it may take a long time to take place because China publishes its own numbers and continues to maintain a strong grip on its economy. There is no guarantee that they will not continue to kick the can down the road, and they have the capacity to inject as much money as is required to deal with the situation, at least in the short term. Finally, in an odd way, China's slowing economy and the global recession may help to ease demand for higher prices. With fewer resources consumed, inflation may begin to abate or even decline. Many of these are very broad presumptions, with no conclusive timeline for when they might occur, but it is a very concerning sign that we won't know the full extent of what is to come until it might be too late. That's all we have for today. If you'd enjoyed the video, why don't you give us a like and subscribe to our finance channel? Don't forget to hit the bell button below to get notifications on when we'd post next. Thank you for staying till the end of the video and hope you enjoyed. See you next time.